The Fed is expected to cut interest rates this week for the first time in 4 years. They are meeting on Wednesday, September 18th, and it's expected that they're going to cut interest rates by 25 basis points or 0.25% for normal people or 50 basis points. Back in August, the Fed Chair Jerome Powell said the time has come for policy to adjust. Now, we don't exactly know by how much, but what we can do is look at expectations using this Fed Watch tool, which uses 30-day pricing data for Fed funds futures to see what investors are pricing in or what they are expecting the rate cut to be. Right now, the federal funds target rate is between 5.25% and 5.5%. And the expectation in terms of are they going to lower it by 25 basis points or 50 basis points, it's split about 50-50. For those that aren't exactly sure what this means and feel like it's a little too late to ask, the federal funds rate is simply the rate at which banks borrow and lend excess reserves to each other overnight. And this is important because this interest rate impacts a lot of the rates on loans and debt investments all across the economy. And this rate is set by the Federal Reserve, and the current target range for that rate is 5.25% to 5.5%. Now, the Fed uses the tactic of modifying that rate in order to accomplish a couple things. Number one, to stabilize prices or to manage inflation and to optimize employment. So back in 2007, 2008, during the housing crash, the Fed wanted to re-stimulate the economy because people were pulling out their investments, holding onto cash. We were in a recession, and they wanted to encourage investing and bring down unemployment. So they cut rates over the course of 15 months and brought interest rates down to 0% in December of 2008, and they left it there for 7 years. Now, I'm not going to go through every Fed rate change, but the next notable thing that happened was that thing that we all experienced in 2020, and we started to see the effects of government overspending and supply issues in 2020 and 2021. So in 2022, the Fed started to raise interest rates. Now, the idea here is that if you raise interest rates, people are going to be less inclined to take on debt, so less inclined to buy houses, buy a car, theoretically take on credit card debt. Businesses are less inclined to get business loans to expand, so that will bring down demand and as a result, bring down prices. So they raise interest rates to slow down the economy and they decrease interest rates to stimulate the economy. So from March of 2022 to July of 2023, they raised rates from 0% to that 5.25% to 5.5%, which is where it's at today. And that brings us to the end of 2024. Now, August CPI numbers were recently released, and year-over-year inflation, as measured by the CPI, has stayed down relative to what it's been over the past 3 years. The August 2024 Consumer Price Index rose 0.2% month over month and 2.5% year over year, which is the smallest annual increase since February 2021. Now, as a reminder, things are still getting more expensive. Prices are still rising. This is disinflation, not deflation. Disinflation is when the rate of inflation or the rate at which prices are increasing is going down. Deflation is when prices are actually coming down. Now, there's a conversation to be had around how CPI is calculated because they've changed the way that that number is calculated over the past several years. And there's some controversy on whether that's actually a good proxy for inflation. Maybe a video for a separate day, but all that is to say is that is what the Fed is going to use when justifying a rate decrease. Another thing that they're going to look at is unemployment. On September 6th, the August jobs report was released, which showed a slight decrease in unemployment, but overall a slowdown in the jobs market. So employers are adding jobs, but at a slower pace, which is further rationale for the Fed to cut rates. The theory is you cut rates, businesses expand and invest in more initiatives that require more jobs and improves employment. So inflation and employment are two big things that the Fed is going to look at when making this decision. The problem with this is that using interest rates it's a very blunt instrument. It's like if you were going to build some furniture. Let's say you wanted to build a desk, and instead of using a table saw or a miter saw to get some of those nice, precise cuts, you use a chainsaw. Yet you accomplish the goal of cutting two pieces of wood in half, but it's going to be rough around the edges. Interest rates are just one factor of prices and employment. It's just one dial being turned when there are a multitude of forces at play. Another thing that makes this tricky is that it normally takes 12 to 18 months to see the full impact of interest rate changes, and a lot can happen within that time. So imagine driving a car and it takes 30 seconds before you can brake or accelerate. It would be tough to get from point A to point B without some casualties. And the other thing worth mentioning here, and this is a bit of a tangent, but inflation is more of a symptom of a deeper problem. It's not the problem itself. It is a byproduct of excessive government spending. As long as the government continues to spend more than they're bringing in, inflation will persist. The rampant inflation that we've all experienced over the past several years was largely in part due to excess spending in 2020 and 2021. Now, yes, there was a big thing we were dealing with those years, and the supply chain got messed up, and that played a role as well. But we had a $3.1 trillion deficit in 2020 and a $2.8 trillion deficit in 2021. Almost a $6 trillion deficit got racked up in just those 2 years. And, manipulating interest rates can maybe curb the problem with inflation, but it really doesn't get to the root of the issue. It's like if you found a leak in your roof and it's dripping through and damaging your floor, and you spend all of your energy and effort trying to find the right bucket. And that's all you ever do. Sure, you stopped it from damaging the floor further, but you still have a leak. You didn't get to the root of the issue. And now you're constantly going to have to be monitoring the weather and watching the bucket and swapping it out because you really didn't solve the problem. You just dealt with a symptom of a deeper issue. But that's a tangent and maybe a topic for another day. But I think the greater question is, how is this going to impact you? Let's start with your investments, particularly the stock market. Historically speaking, the stock market has reacted positively to falling interest rates. Although it's very situationally dependent because there are a lot of things at play beyond just interest rates, what's really important is what is the expectation that these lower interest rates are going to have on businesses? And I already kind of alluded to that earlier. When interest rates come down, borrowing costs are decreased, so businesses are more incentivized to expand and invest in other projects that will ideally lead to higher profits. You also have higher consumer spending generally when interest rates come down, which would lead to higher revenues. And then as rates come down on fixed income investments like bonds, CDs, high yield savings accounts, people are less incentivized to keep their money there and move them into the stock market. Here's how the S&P 500 has reacted to falling rates in the past. So all years in which the Fed has reduced interest rates since 1962, on average, the S&P 500 has earned about 10%. Now, situations where the Fed rate was above 5% and inflation was below 3%, which is where we're at now, the average S&P 500 return in those years was 14%. Now, there's some correlation versus causation here, but generally speaking, the stock market reacts positively. On the contrary, with bonds, CDs, and high yield savings account with fixed income investments, obviously as rates come down, yields are going to come down on those. Now, Treasury yields typically move in anticipation of the Fed rate. So by the time the Fed makes the announcements, those rates are already factored into Treasury yields. In the immediate term, we could expect a decrease in high yield savings account rates. Unfortunately, it's been fun, but you'll probably get an email from your bank within a week of the Fed making the announcement. That'll be an immediate impact. And newly issued CDs, those will probably be impacted pretty quickly as well. Now, let's talk about how rate cuts impact loans, particularly mortgages, since that's kind of the forefront of a lot of people's minds. So since mortgages are a long-term instrument, these tend to follow rates of the long-term Treasury yields and not so much the federal funds rates. So mortgages today have already reflected the anticipated moves of the Fed. If we look at mortgage rates since May, they've continued to come down in anticipation of the Fed moving these interest rates. So don't expect a sudden decrease in mortgage rates the moment the Fed makes the announcement, unless the Fed does something wild that we just don't expect, like they don't reduce rates at all, or they cut rates by 1%, which is not going to happen. But largely, rate decreases have already been factored into mortgages. For existing student loans and auto loans, obviously those aren't going to change. Those are fixed. But for newly issued student loans and auto loans, I would expect those to start coming down as well. Auto loans are more shorter term, so they are a little more influenced by the Fed rates, but they're also influenced by the dealer promotions and all that. I think loans where you'd see an immediate change are things like credit cards or adjustable rate mortgages, or things like a HELOC, which is often tied to the prime rate, which is closely tied to the Fed funds rate. So when the Fed makes the announcement, adjustable rate mortgages, HELOCs, credit cards, those rates will come down pretty quickly. Okay, so is there anything you should be doing in anticipation of the rate cuts? Largely no, but one thing that you might want to consider is locking in a 6 or 12 month CD at current rates, knowing that rates are going to likely continue to come down over the next year or two. You also may want to consider how much that you have sitting in cash, like in a high yield savings account. I mean, a 0.25, 0.5% decrease is probably pretty small, depending on how much you have in there. But those are going to continue to come down. So it may be something to start thinking about, shifting out of that and into some higher yield investments, assuming it fits with your goals. What I would not do is try to strategically time investment or purchase decisions based on this decision, particularly in the stock market. Like I wouldn't try to get in or out of the stock market based on how I think the market is going to react to the announcement. That is largely already priced in. Where you'd see a jump in prices is if the Fed said something that was completely unexpected, or they said something that shifted how we think they feel about the future. Overall, timing the market normally does not work well. Same goes for trying to buy a car or a house. I wouldn't pass up a great deal just in the hopes that rates are going to come down fast, and then you can start looking. There's generally an inverse relationship between prices and rates. So as rates come down, prices are going to go up, and vice versa. So if you find a good deal or you need that thing, I would not let interest rates be the primary driver of that decision. We'll see what happens. If you found this helpful, like, subscribe, and I'll see you next time.